Okay, everyone, I hope you can hear me. It's Alan Shannon. For those of you that I'm repeating myself to, my apologies, but I think we just had a slight issue with the audio. So we're going to start again. Just a quick introduction. I'm the head of client engagement for Retail Relationship Banking. Retail Relationship Banking in the Nedbank context is our professional banking business. And I think more importantly for the purposes of this discussion, I represent our small business services operations as well. So I think what we're trying to do today is just to give you a practical sense as to what effective engagement with your bank looks like. And certainly we're of the view, perhaps biased in our view, that as a bank, we're a critical partner for the success of any business. We're certainly an essential part because paying and receiving funds is something every business needs to do. But I think the purpose of this discussion is try and see how we can go about enabling you at a more practical level to go about securing funding from your bank. And securing funding from a small business perspective, we think is one of the most important things as a banking institution enable you with. And so today is just to give you a sense of some of the practicalities associated with doing that. So it's a little low in theory, and it is my sort of couple of decades of experience in dealing with small businesses through the banking system, and I hope you will find today's sessions useful to you. So I think in a little bit more detail, I think what's important for us to do is perhaps just help illustrate how we see the differences between how we look at life versus how entrepreneurs do. Again, just some practical thoughts to consider, specifically if you're serious about receiving funding from a commercial bank. And we'll give you a little bit of a sense as to what we as commercial banks do, where we are strong, and perhaps I'll give you a sense also as to where we're weak, because I think we're not all things to all people. We're particularly effective at doing certain things, and it's that which I want to sort of impress upon you during our discussion today. And I think also just to highlight some of the mistakes that we feel you'd like to avoid when seeking funding from a commercial banking operation. So I think just first up to highlight some of the differences between how we function and how we see entrepreneurs functioning. So it may feel a little obvious, but I think understanding the differences is quite an important thing to understand. So we have an appreciation for how you guys deal things as entrepreneurs and how we deal things as bankers. So I think just first up front, we don't deal the grey well. I think for us, what's really important is understanding the detail, understanding the sort of black and white insofar as the numbers are concerned. We are very analytical in our approach, and we operate within what we refer to as a regulatory minefield. Regulation is particularly important for us to comply with. To the extent that we as banks don't comply with the regulation, then we put all types of things at risk, not least of which is our banking license, as well as facing the prospects of fines from the authorities. So I think bear that in mind when we ask for certain information as financial institutions. We do so because not only do we need to sort of satisfy ourselves with the risk that we're taking, but we also need to satisfy the regulators that exist out there and keep us all honest. I think from a risk point of view, certainly in your eyes, we will be seen as being conservative, perhaps in most eyes. There's a good reason for that, though. So I think perhaps just to help you understanding of our funding side of our business in particular, we operate in very thin margins. Typically, on the lending side, our margins are sort of anywhere between the sort of 2, 4, maybe in some extreme cases 5%. And so when we do write off money, we're writing off money against what are already very thin margins. Unlike, I think, for the most part, how entrepreneurs operate in much larger gross margins than what we as financial institutions do. And so your appetite for risk will be higher as a consequence. I think a little bit about how we at least see entrepreneurs, certainly relative to us bankers. You guys are a lot more creative. I was blessed to have been part of a process last night where we were adjudicating a whole bunch of entrepreneurs, and I think there was the one theme that came out amongst all of them is that they were very creative people. You're undoubtedly self-starters, otherwise you would not be in business in the first place. I think the detail that is important to you is perhaps a little bit different than the detail that's important to us. And for some of you, details may not be important at all. That being the case, that would be one of the key differences between us as bankers and potentially you guys as entrepreneurs. There's no doubt about your determination and your confidence. I think if you were not determined and confident, you would not be in business at this particular point in time. Again, just given the broader macro environment in which we're operating, we understand that it's tough out there. And there can be no doubt that for the most part, you have to be optimistic, adventurous, and risk takers, certainly relative to us as bankers. So I think there is common ground, however, between us as bankers and you guys as entrepreneurs. And I think the common ground relates in some fashion as it relates to money. So I think the one thing that banks do have, and dare I say an abundance of, is money. That's what we deal in. So we have it. We know for the most part entrepreneurs need it to go about meeting their aspirations and growing their businesses. We both love it and would like to make more of it, and together I think we can. In fact, as a bank, unless we're lending out the funds that we obtain from our deposit takers, from the capital that we attract, we'll be making no money. So really we need to be working together more effectively to make sure that we enable you to make more of it, and that we as a consequence make more of it too, therefore sustaining each other's existence. So I think there's a very important piece of common ground between us. And I think, to give ourselves the best opportunity to get to the point where we're providing you more of what you need to fulfill your needs, it sort of requires us to sort of perhaps spend a little bit more time and understanding what it's like to be in each other's shoes. So I think what we're going to try and do here is give you a sense as to sort of what putting your best foot forward looks like, and what it looks like sort of walking in a banker's shoes, and specifically what we look for when we're engaging small businesses with the intent of trying to assist them with their funding. So I think that the first thing we need when engaging with prospective clients or even existing clients that are in the small business sector is you need to help equip us to understand what it is your business is about. And I think very specifically, over and above helping us understand, what you do and how compelling your value proposition is, and how successful you are in attracting new clients, we need to understand things such as your working capital cycle. So the working capital cycle is nothing more than understanding how long it takes you what the time is it takes you between when you pay out the money for things such as your raw materials to the time in which you go about collecting the funds from your clients for having provided them with the end product. So typically in a manufacturing environment, it starts with buying raw materials. It transitions into those raw materials going through a process, which can often involve machinery, can involve labor. That transitions then into the goods physically being delivered out to your client, which then results in invoices being generated, and then over time, your customers eventually paying you. Now that process is the working capital cycle, and it's often the thing that can get small businesses into a bit of a cash crunch, because that process can often be months. And keeping your operation alive for a matter of months and producing new orders and gaining more raw materials can be a big investment requirement. We as banks are particularly good at helping that process, but we are better enabled when you equip us to understand the specifics as it relates to your working capital cycle and how it relates to your business. So, that we achieve through discussion, engaging with you, preferably at your place of business so we can understand these things even at a level better. But I guess you need to be open with us and help us understand how it works for your business in particular. We will render advice back as to how it potentially could work even better for you, but having that understanding for us is crucial. The next thing for us, and this is an area that I think specifically with younger businesses, we certainly as banks have challenges with, and that's just around having your, as a small business's documents in order. And documents is quite a far-reaching concept. It could be simply your business registration documents. More often than not, we have a real deep interest in the financial statements that you would be producing at a management account level, perhaps monthly, and certainly at an external accountant level, at least annually. Having that stuff in order is crucial. I think, entrepreneurs are very good at investing time in understanding their value propositions and crafting those value propositions. They're very good at investing time and engaging with their customers and trying to attract new customers. And I know this will feel like a terribly generic statement to make, but certainly in our experiences, the entrepreneurs themselves could be spending more time invested in making sure that their sort of finances are well understood and kept in order, and result in being demonstrated in black and white, and it certainly helps prepare us to put us in a better position to try and help you when your funding requirements are well understood. So keeping your documents in order, specifically as it relates to your financial information, for us, I cannot overemphasize enough. At least from a banker's perspective, it is critically important. Then I think the next point is just your openness with your bank. So as banks, over and above what you supply us with, we have our own processes in the back end that sort of validate certain of the information that you would have provided with. We have access to the credit bureaus. So I think the one thing you can do is be as open and forthright with us as early in the relationship as you can be. If there is, for whatever reason, a credit record that you would rather we didn't know about, be open with us upfront about the fact that that potentially exists, because our resources allow us to find out about that in any event. So our view is, be as open and transparent with us as you possibly can around anything that you think is going to sort of be important for us in coming to a determination around whether or not we can provide you with funding. I think the next thing is understanding what banks can and cannot do. So I'll elaborate perhaps this in a little bit more detail a little bit later in terms of where banks fit in versus where some of the perhaps alternate funders fit in. Banks are not particularly good at providing startup finance for new businesses. So I just want to put that on the record right from the get-go. It would be irresponsible for me to suggest otherwise. Where we are good is helping small businesses that have developed even a small track record to reach their growth aspirations. So to the extent that you can demonstrate to us that you are in business, that you can generate some positive cash flow, which doesn't always mean that you need to have a positive cash balance, and that you can turn a profit, to the extent you can generate information that can assist us in understanding that, we can do a good job of helping you reach the sort of step change in growth that you're going to be looking for in your business. But right up front, we're not great at providing startup funding, not unless you've got lots of security to protect us in the event that things go wrong. And so again, I'm telling you this up front in the interest of being transparent, because I don't want you thinking commercial banks are going to be that person for you if it's startup funding that you're looking for. I think the other thing that you need to try and do, and I think as banks looking at small businesses, the credit record is crucial, and we have access to sort of bureaus within South Africa that help us understand these things a little bit better. The business itself will not have a credit record at a bureau, because the bureaus are more interested in gathering the credit records of the individuals that exist in our society. And so when it comes to us looking at the business, what we're really interested in from a credit record point of view is how you as the entrepreneur have conducted yourself over the sort of months and years preceding your engagements with the bank. And so building and maintaining a credit record is a very valuable thing to do. It starts with something as simple as building a credit record with the likes of Edgar's. All these things are sort of tracked and maintained. And even something as simple as creating a record that tells us that you're good at paying back a clothing retailer tells us something about your character as an entrepreneur and your intentions with the bank going forward. I think also really important is to get to know your banker. So be very inquisitive, ask lots of questions, and explore all the banking options, of which there's a vast number. I think core to what we do as commercial banks is provide short-term, medium-term, and long-term funding. Short-term funding is typically facilities that have a sort of lifespan of a year or are repayable on demand. Medium-term finance more relates to your need to finance equipment, motor vehicles, and long-term finance, generally speaking, relates to property level type transactions. So that's just to maybe give you a little bit of insight as to what it means to walk in banker's shoes for a moment, and the type of things that are important for us. When it comes to getting prepared for applying for finance, obviously there's a strong need to engage your banker so that they can sort of help guide you as to what the best funding option is for you. Whether it is short, medium, or long-term in nature, your banker will guide you insofar as that's concerned. Guidance typically comes when you say you want to finance a bakkie, and they will tell you, well, to finance a bakkie, in fact, is something that you should be doing is of medium-term nature, and so not to tie up your cash flow. They will recommend the specific products that are going to be relevant to the specific need that you have. But in terms of what you need to be presenting in terms of information, I've listed down here some of the stuff that your bank is going to most definitely want in making an assessment. And the way bankers operate is that you will typically engage with a relationship person who will be your primary point of contact for however long you're banking with that organization, or however long it takes for that person to sort of see an opportunity in another role. In the back end are a credit assessment team. And that credit assessment team are going to want the sort of information in its financial form, which we'll talk about in a second, as well as they will want information from the banker that you've been engaging with around what they understand about your business. So the first thing we will ask for as bankers is a set of your financial statements. Generally speaking, you will produce these once a year. They will be produced by a public accountant. They do not need to be audited. The legislation around that has changed over recent years. To the extent that you don't yet have a full year's trading history behind you, or your financial statements are more than 6 months out of date, generally as bankers, we will also ask you for things called management accounts. And management accounts are really the internal accounts you keep on your business that helps us understanding, within the space of a year, how performance is going within your business. So we're interested in that because we're trying to understand the sort of trends that are developing within your business. The annual financial statements give us a good historic view of what's happened in the preceding financial year. Management accounts help us understand what's happening currently. And so looking at them alongside your financial statements for us is important to understand whether, sales are up, sales are down, gross profits up, gross profits down, overall profitability is going up or down, and where you're sort of investing your money and your cash flow. So, having that information for us is critical for us to be able to sort of get off first base and understand how your business is performing. And we want to know that because it gives us a good insight as to how the business has been run. And that in itself gives us good insight as to how we could potentially see the business being run into the future. So I think it's fairly logical to come to the conclusions that a well-run business will continue to be well-run, and poorly run businesses perhaps need some course correction. We can certainly give guidance in that, but hopefully understand the concept. The next thing we talk about here is giving us an age analysis on your debtors, essentially those people that owe you money. We want this for a couple of reasons. I think probably primarily is to understand, one, what is owed to you, so we can see what sort of cash flow you can expect to be getting into the business. And secondly, it helps us understand how well you are running your debtors book. So to the extent that we see a lot of your customers owing you money in excess of 90 days, it generally gives us as bankers the message that, you're perhaps not as focused as you should be in collecting the funds that are due to you. And so it gives us some really good insights as to sort of how you're running your cash flow. Cash flow forecasts, this is a really interesting sort of notion. What we're asking for here is for you guys to sort of project into the future how you see your cash flow sort of panning out into the future. So it's essentially a function of the cash you expect to get in, a function of your expenses going out, and what cash flow you're left with at the end of the month. Now, if I can give you any advice insofar as this is concerned, my advice would be to remain conservative insofar as this is concerned. I've yet to see a cash flow forecast coming through that is not optimistic by its very nature. Every entrepreneur out there, I think for the most part, is optimistic about what will happen from a cash flow point of view. Our view would be try and remain conservative, because sometimes the over-optimistic stuff is a little unbelievable, and we're not sure it's a realistic view of where you can expect your cash flow to be. So remain conservative when producing us cash flow forecasts. If it's something you feel a little uncomfortable with yourself, draw in the services of a bookkeeper or an accountant, or even your banker for that matter, who will help perhaps give a bit of a reality lens to some of the cash flow forecasting that you're doing. And then because businesses, small businesses in particular, are largely a function of the entrepreneurs that run these businesses, we're quite interested in understanding sort of what you've been able to generate in terms of personal wealth over the years preceding your engagement with us. So we will typically ask you for a statement of your own personal assets and liabilities. And I think one of the standard requirements you'll see out of pretty much any commercial bank is that when it comes to lending money to your business, the bank is going to want to tie you into that obligation as well. And so this is a general rule within commercial banks, specifically in dealing with the sort of small and medium business community. Shareholders and owners of those businesses will be asked to provide the banks with personal suretyships in relation to the facilities that are being granted to the businesses. What that actually means is that in the event that your business defaults and doesn't pay back the financial institution is going to come after you as a business owner to try and recover the funds that are due to them. So it is a standard requirement. I can tell you it's in exceptional circumstances that banks, generally speaking, will waive that requirement. And I think, again, just to help you understand how we as commercial banks think, to the extent that a business owner refuses that requirement, it sort of has us questioning the commitment of that entrepreneur towards that business and that entrepreneur's confidence towards that business being successful. Providing that suretyship tells us that you are confident and that you are committed, and essentially in the early stages specifically, you are that business's route to success. Without it, we can't rely on the business being successful as it otherwise might be. And then again, I'll make the point around a clean credit record. Just on this, there is an issue of materiality. So if you have a credit record that has a blemish on it, there is a materiality as it relates to what that blemish is. So having a blemish in the form of owing another financial institution a large amount of money is a bigger blemish than owing potentially Telkom 300 Rand. That would have less materiality and less relevance for us. And there may well be plausible explanations for either scenario, but we do look at credit records and materiality of the blemishes to the extent that they exist. My advice to all of you is that try and have a blemish-free credit record. It's going to enable you, whether it's in your personal capacity or in your business capacity, to get what you want out of a financial institution. Okay, so then just moving on. What to avoid. So I guess it's the sort of contra of everything that we've spoken to up to this point. I think like any relationship, business or otherwise, first impressions count for a lot. So, to the extent that you are unprepared, it would have us asking questions around how well you understand specifically the financial side of your business. So we would urge you not to be unprepared. Be sure about what you want and what it's going to achieve for you. So I think as banks, we want to be involved in businesses and help fund their future profitability. And so what we're asking you in this particular point to do is try and demonstrate for us what this funding would mean for you. So whether it's the funding of a new bakkie that's going to be running around doing deliveries for which you're going to be earning revenue, or whether it's funding to help sort of bridge the profits that you're going to generate out of this working capital cycle that we spoke about a little earlier on, help us understand what it is the funding is going to help be able to achieve for you. And avoid sort of the hypotheticals. I think we love facts. So for instance, to the extent that you've been successful in securing a tender or a contract, physical evidence of those contracts or those tenders being awarded helps us sort of, again, build confidence in the business that you're building, and that, what you say is happening in terms of your growth prospects is in actual fact the case. And then I think sort of made this point, a poor sense of your finances, specifically from our perspective, I think suggests that, your business may have sustainability issues if you don't understand what the finance of your business looks like. It is often, if not exclusively, the finances that end up tripping many a business up. And I think don't withhold any information, because often the information will come to light, specifically, again, given our access into some of the other channels that enable us to be able to assess the risks. So I think high level, what we want you to do is know your stuff, when you're engaging with us. It's most certainly going to be enabling for you to be able to access from us exactly what you want from a funding point of view. So then just moving along, maybe just to give you a quick recap on the sort of types of funding. I've talked about the sort of short and medium and long-term nature of some of the funding that we as commercial banks present. Within each of those elements is, and let me perhaps just go back, is a lot of alternatives. So on the short-term side of things, we're typically talking about overdraft funding, debtor finance. We have some really neat finance solutions specifically for people that are retailers and make use of point-of-sale machines. There's facilities these days that will provide you with funding, and we will collect it in a manner that is conducive or aligned at least to the cash flow that you're sort of clawing into your business on a daily basis. Short-term funding is typically there, as I've mentioned a couple of times during this discussion, to help you with your working capital cycle. This period of providing your clients with a service or a good, and ultimately to when you go about collecting funds. If your business is going through sort of low growth, ultimately your working capital cycle should be self-funding. But specifically, if you're going through sort of quite high growth in percentage terms, short-term funding is probably something you're going to find yourself having a need for. Medium-term funding is there, as I've again mentioned, to finance the things like the buckies or the machinery that you're going to require to turn your raw materials into a finished good. Typically, medium-term funding is up to about 6 years, and we generally try to align the funding mechanism with the useful life of the assets that you're looking to acquire. And as I've mentioned a little previously, long-term funding is generally there to sort of help you when your aspirations are to acquire commercial, industrial property to support your business, or residential property for that matter, if you're looking to acquire a home for you and your family. So that's just very high level, sort of the various funding mechanisms that exist within the traditional banking environment. From an alternate point of view, and I'm mentioning this because I said up front that we are not all things to all people. And there is other players out there that may be better geared for us to take on a different level of risk if that's what you're seeking. We often see businesses starting up because family and friends have helped provide some of the seed capital to get these businesses off the ground. I think an area we've seen quite a significant amount of growth over the last 3 or 4 years in particular has been crowdfunding. Crowdfunding is being used for a whole variety of things. You may have heard in the airwaves not so long ago, crowdfunding was even used to recognize a petrol attendant that had done a particularly good deed down in Cape Town for a lady I think who had a flat tire. There's private investors and venture capitalists. I think they're particularly interested in the bigger type deals that sort of that present risk but present very high potential upside. And those type of guys are often going to want a slice of your business. And then, of course, there's government agencies. And I think as banks, we're trying to get a little bit closer to working with government agencies to see how we can sort of collaborate together. But areas such as the Small Enterprise Finance Agency can be a useful resource for certainly some of the small businesses out there requiring funding assistance. And I think you've probably come to this webinar today through the sort of SimplyBiz resource. So you've already found your way there. I think just navigate and play around with the site and see what it has to offer you. I think I won't elaborate any more on that necessarily. And I think that's what I wanted to present to you. I'm not sure if there is any questions that I can perhaps answer. So just allow me just to sort of have a look here. I've got a question from Seppo, who asks, do banks provide unsecured loans to really promising business plans, even when the founder has no existing funds to start up? So again, that's probably our area of weakness. If it is truly startup, the answer to that question is more than likely going to be no. If, however, you have been able to demonstrate even a short track record, and by short I'm saying probably at least 6 months, where you're able to sort of document and you can validate for us how you've been able to trade, it's a good starting point for us to put some money into your business, probably in this type of scenario through an overdraft type facility. And we will most certainly try and mitigate our risk with some security if that is available to us. It is difficult to give you sort of a specific yes or no to what would be potentially your scenario. But generally speaking, it is going to be difficult to source unsecured funding from a bank for the purposes of startup. In fact, it's almost nigh on impossible, to be honest with you. But show us a short track record that you can demonstrate a level of profitability, as small as that is, and I think you've got a very good starting point to get funding from a bank. I think Seppo's another question. Most startup founders with previously failed businesses usually have a terrible credit record. Yep, we've seen that. From seeding their businesses and using credit cards. Is there no redemption for such entrepreneurs starting again? So, I mean, there is. And I think as Nedbank in particular, we provide an account which we call a business enabler. And a business enabler has been particularly designed to sort of try and help businesses or business operators that had perhaps been in business previously and are being turned down by other banks because of the previous track record from a credit point of view that they developed. Business enabler is there to try and get you back on your feet again. You would need to be in a business enabler account demonstrating, again, some form of trading record before we would necessarily be prepared to provide you funding. But it does get you access into a bank account again, despite your credit record, and it does allow you to reestablish yourself. And once you sort of again demonstrated a track record, it puts you in a stronger position than what would otherwise be the case to negotiate future funding with banks into the future. I think just on this particular point, Seppo, the one thing I'd perhaps like to elaborate on, the character of the business owner from a banking point of view is critically important. You help yourself in getting funding when you have a previous blemish on your record, when you can demonstrate to us that you remain committed to eradicating that blemish from your record. So to the extent that you can show us you're in a repayment arrangement, that you've been sticking to that repayment arrangement, you build confidence with us as bankers that you are good for your commitments and that you won't let us down as a finance institution should that ever take place. There's a question from Given. Would you recommend a business outsource its operations manufacturing of goods up until a point where they can afford their own machinery? Is that a wise decision? I mean, I think it's a reality for many businesses that are looking to get off the ground, and I've certainly seen that play out. Of course, in the early stages, what it does mean for you is that your gross profit is probably going to be less than what it possibly could be. But I think as a mechanism to get off the ground, I would certainly advise that as an option, if that option is available to you. And then sort of buying equipment and things like that is a big commitment. And it's a long commitment as well, because it's going to be a matter of years before you've sort of paid back the investment that you've made into that commitment. So I'd certainly advise that. And to the extent that you believe you have a sustainable business that you can generate an increased gross profit from by acquiring your own machinery, I would also advise that when you believe you've got that sort of sustainable model, and given that's going to offer you a better gross profit. And then there's a question as well around financials. It says, do I have to have financials from an accountant? Could I submit my business income and expenses recorded on an Excel spreadsheet? I'm a really small business still. So you must certainly, so what is being referred to here is essentially the management accounts. These are the income and expenditure statements that you craft on a monthly basis as a business owner, and we find that stuff immensely useful. As a business owner, though, ultimately you are going to need to create formal accounts on an annual basis through a public accountant who gives their independent view as to how your finances are operate. Now, one of the most valuable things for us as a bank is seeing how your management accounts correlate back to what your public accountant is saying. And to the extent that we sort of see alignment between what the independent view is and what your view is as managers, then you build a lot of credibility with banking institutions because we see that level of alignment. And so ultimately, yes, a public accountant needs to do your accounts, but your management accounts are going to be really helpful in addition to the public account scenario. I'm not sure I see any other questions. Let's just have a look. I think that is it. So I'm mindful that we had scheduled to 2:30, so we've got another 5 minutes, although I'm happy to stay on longer if there is any other questions coming through. Okay, if not, I hope that's been useful. Please feel free to reach out to us as Nedbank if you feel we can be of any direct assistance for you. You're a small group of 6 people. I'm not sure what the fitting thing is to do, what email address we should potentially give, or if they've got access. SimplyBiz, okay, you can reach out to us via SimplyBiz. Again, if there's anything specific, and we'd relish the opportunity to engage with you one-on-one to see how we can potentially be of service to you as a small business owner, potentially wanting to strike up a relationship with Nedbank. So thank you. Thanks for being part of the process. And again, I hope you found some value from this discussion. Thanks.